Good evening, everyone. I'm Gianluca Clementi here on the faculty at Stern, and on behalf of the NYU Stern School of Business and all the NYU economics family, I would like to welcome you all to the Backus Memorial Lecture for 2022. And as you know, this year, the lecture will be delivered by Monika Piazzesi, the Joan Kenney Professor of Economics at Stanford University. So this morning, as is often the case in circumstances like that, so Facebook reminded me that it has been 6 years since Dave left us. And I know it sounds cliche, but I said, like, wow, really? It's been already 6 years. It's such huge gap that he left in our lives that I can't fathom how it has been already 6 years. We miss him terribly, of course. So here at Stern, now we have this mantra often that when we are about to take a decision, at least in our department, I mean, one of us comes up and says, what would have Dave done in circumstances like that? Because you know, we admire so much his wisdom and his guidance. Unbelievable. So this year, if possible, the sense of loss is even larger than usual because this year we lost another one of our own. So Tom Cooley left us earlier this year. And so we always, at least I always often think of Tom and Dave as partners in crime, if you want. And in fact, this may be the first time that the lecture is not introduced by Tom. And of course, Tom was a major fan. He loved deeply Dave, and Tom was very much instrumental also in raising the funds to endow the lecture. And when I think of them as sharing this constant desire of always doing the right thing, if you know what I mean. And I mean, in the short run, if you're on the receiving side of the right thing, it's not always fun. But you know that in the long run, it's going to work out. And of course, we are all fans of the long run in here. And of course, they had in common also a strong distaste for nonsense. Right? They did not tolerate nonsense. And so we miss them really deeply. And so today, we are really happy to see members of the family of Dave. So thank you, Marilyn, for coming. And you know, I don't want to take too much time here. I would like to add that so the lecture is going to last 1 hour, and that please limit your questions, in particular to clarification question only, and then we are going to have time later on during the reception that will follow to talk more economics and to ask Monika more questions. And so therefore, without further ado, I will now leave it to Stan that will introduce Monika.
Thank you, Gianluca. David Letterman has a new show on Netflix that's called My Next Guest Needs No Introduction. That obviously applies here, but I can't resist the opportunity to tell a story. Early January 2000, the meetings, the winter meetings, the job market meetings were in Boston. I don't remember exactly, but it was probably miserable and snowy, and we're trapped there for a couple of days. People are nodding, so it must have been the case. What I do remember is the economics recruiting committee and the finance recruiting committee at Carnegie Mellon, where I was working, they weren't getting along. So they booked interview suites at hotels at the polar opposite ends of this big convention center. And I remember literally, not figuratively, literally running through the convention center to get from one suite to the other, and I ended up showing up late and kind of sweaty. And I look in the room, and there's my new colleague, Marvin Goodfriend, who had just joined Carnegie after a long career as a central banker. And Marvin was like really leaning into this interview. And like out of nowhere, he just kind of spontaneously shouts, "This changes everything," which isn't really the typical comment you hear in a kind of an academic job interview. So I was kind of startled. And of course, the person we were interviewing was Monika. And Marvin was exactly right. Monika's early work that integrated kind of frontier macroeconomics, interest rate targeting, monetary policy rules with kind of cutting edge asset pricing finance, arbitrage term structure models, was a really big leap forward for this kind of fledgling area of macro finance, an area that Dave Backus was very passionate about. And it didn't stop there, of course. Through Monika's career doing research, but also a number of really important leadership roles of editing the journal Political Economy and being the head of the NBR's asset pricing program. Monika has really pushed out the frontier macro finance. And in that case, it requires working at the frontier of like 3 different areas, finance, macroeconomics, econometrics, and tackling some of the hardest problems we face, like, trying to understand the effect of housing on the macroeconomy and financial markets, and simultaneously the effect of financial markets and macroeconomy on housing. So needless to say, Dave was a very big fan of Monika's work through the years, and considered Monika a very good friend. So even though she needs no introduction, I'm thrilled to introduce Stanford University's Joan Kenney, Professor of Economics, to deliver the 2022 David K. Backus Memorial Lecture, Monika Piazzesi.
Thank you so much for coming. Thanks for the super kind introduction. Let me first start with comments about Dave. Dave had 2 huge ways he had an impact on me. The first was on my work, and the other was just on me as an economist, person, human being. The first is that as Stan said, you won't see it from the slides I'm going to show you today, but when I started out, I was in high passion with continuous time finance modeling, where I had tooled up taking many courses in probability and stochastic calculus, and I was very excited about term structure modeling. I was so excited about this class of models where you start writing down stochastic processes for some latent variables, and then form predictions about the entire term structure of interest rates. And that involves partial differential equations and being very sort of nice about guessing solutions. So that was all the game that I was playing at the time, was what kind of processes can you write down and still get a closed form solution. It was the time when we introduced jumps into these. So it wasn't just continuous Brownian motion, but there was jumps, and the jumps could reflect things like monetary policy announcements. So I was all into that. And the papers that I would read were typically really dry technical notes written by lots of people with physics PhDs who were much better than I was at guessing these solutions to these PDEs. And so I was deep in, I had spent years on these models until then I meet Dave. And Dave had worked on discrete time versions of these models. He had, together with his colleague here, Foresi and Telmer at Carnegie, developed discrete time versions of models that had all the things that I was working on in his model also. And he also had nice solutions. And for me, this came as a shock. I was in complete shock when I saw Dave and his work, because the work was beautiful, and it was so intuitive, and it was so much more intuitive than the stuff that I had been doing for years. And the way he thought about it was so much more intuitive, and he had reasons to put in things that I just had put in because it was cool that I could solve the model even then. And he had reason, he could tell me why he wanted to put this in. And I had like there was no understanding until I met Dave. I think this is how I would put it. I was fascinated by some piece of math and statistics, and then I met Dave, and it all made sense that we really have to think about these things and how they connect with the economy. And I saw connections that I couldn't see before meeting Dave. And so I would say that had one of the most profound impacts on me in terms of early work, because it was just a totally different way of thinking about these models and the behavior of interest rates. It was just fascinating. He was passionate about it. I was passionate in a totally different, nerdy kind of way, and he was passionate about it in a very, he sort of brought economics into these models that I wasn't able to see at the time. So this changed the way I thought about this literature, and I think I wouldn't be where I am today without seeing his version of doing these things and introducing nice, simple ways to relate this material to things we know from time series, econometrics. And so I didn't see all of these connections until I met Dave. The other huge impact he had is through his positive nature. So Dave has a way of being happy to see new research that is just very different from the average economist. The average economist I think has a chip on their shoulder because your papers have been rejected so many times. You've gotten so many bad criticism from audiences. You've got rejected tenure. There's so many bad things that happen that the average economist is a grumpy person. And if you go out there and you give a talk like this one, I've never given this talk, but I thought, I'm going to give it, first of all, because it relates to Dave's work on quantitative modeling. So this is going to be a quantitative model just as Dave would want it. And the other thing is, I've never presented this before, and I think I'm going to hear comments that I never thought about. And that's exactly the kind of situation in which Dave was amazing. So Dave would always express huge enthusiasm about seeing something new. And so you knew that there would be this room of grumpy people, but you had one fan in the room, and he was very happy to hear the research. And so that was, I think, when I think of Dave, I hope I can be more like him, because I do think it's important to be to give the kind of feedback that he used to give. So I'm going to stop and say we miss him. Okay, so this is this is joint work with Boas Abramson and Tim Landvoigt and Martin Schneider. And so what this is trying to do is, I'll try to use it again. Okay, now it's working. So here, let me motivate what we're doing here with a picture. So what you see here is vacancies for rent and inventory for sale in housing markets. And each dot here is a metro area in the US. Some dots are larger. That's because they're larger metro areas than others that are smaller dots. And so as your eye looks at this graph, you see basically a positive relationship between vacancies in the rental market and vacancies in the for own market. So inventory listed for sale is positively related to vacancies in rental markets. Here's with colors of the census region. And so what you see is that blue is the west of the US has lower vacancies for rent and lower inventory for sale, while if you move in other regions of the US, you have more of that, more inventory, more vacancies for rent. Okay. This is, by the way, I can tell you this is New York. This big blue dot here is New York, the New York Metro. And the way this is usually expressed in the housing literature is in terms of months supply. So you just relate vacancies to turnover, and that gives you time on market. And so what you see is that time on market in the two markets is positively related. So you have the rental market here, you have the ownership market on the vertical axis. And so what you see is that markets where you have properties sitting on the market for a long time to wait until they get rented are the same markets that, the same areas where houses sit a long time when you list them for sale. So there's this positive relationship. And so when you open the newspaper, you see all this talk about housing shortage, but here there's lots of vacancies in the picture. And so, of course, you think, well, some of that is frictional. There are frictional vacancies, just like in the labor market, you have frictional vacancies, and then you have maybe some structural vacancies, but you would like to know how large are these structural vacancies. And so for that, we need a model. And the model is a search model of the rental and owner market. We're going to put in some financial frictions. And we're going to estimate this model with data from the cross-section of US cities. And what we find is that in most markets, these structural vacancies are negative. In some places, this is because mostly it has to do with the cost of construction. So the cost of construction varies, and that puts in structural vacancies, negative ones. So there's excess demand for housing in these markets. Typically, it's mostly structural vacancies in the rental market. You don't see them as much in the owner-occupied market. And so that makes you think that what we need to study is policies that encourage the supply of rental units more than the supply of new units in the ownership market. So this is where I'm heading. Let me relate this to prior work so that you can see where we're coming from. So the typical search model has some mass of houses. Let me call that H. And then it also has some mass of households. Let me normalize that to 1. And so then you know that each house is either occupied or it's in inventory. It's listed for sale. And the people, this mass 1 of people, either they occupy a house or they're looking for a house. And so if I subtract off these two equations, then I get the difference between inventory and the number of people searching, which is equal to the difference between the number of houses and the number 1, which is population. And so I'm going to call that object structural vacancies, because if we shut down all the search frictions for a moment, then just the mass of houses relative to the number of people, that's going to tell me how much demand there is for housing in that market, whether there's too much housing or not enough. And so this number can be positive, in which case if we have too much housing relative to the number of people, or it can be negative. And so you say, why do we need to sit an hour to wait for the answer to that question? Why don't you go ahead and measure what this difference is? That's because there's very little data on who's searching. So that's the data paucity in housing research, is we don't have good data on who's searching in the housing market. So what you observe is what's listed, both in terms of rental units, also what's listed in terms of in the owner market, but you can't observe how large S is. And so if you don't know S, you can't measure this difference between the number of houses and the number of people. And so what you can do is say, and so this typical approach in the literature is to say, well, we observe the number of matches. So we observe how many times a house gets transacted. We see how many rental contracts get written. And so let me count the number of matches. then the number of matches divided by inventory gives you the time to sell a house. And the number of matches relative to the number of people searching gives you how long it takes for either the buyer or the renter to find a house. And so then what you assume is you just say, okay, on average, the time to sell is equal to the time to buy. And that gives you I equals S, because these two ratios are, if you set them the same on average, then you get that on average inventory is equal to searchers. In other words, that implies that the housing stock is equal to 1, which is just the number of people. So you just you're matching the number of people with the number of houses. Of course, that's an assumption, and why do we make the assumption is because we have no data. And so there is some data. So for example, there are buyer and seller surveys, and so there's some great research looking at the answers in these surveys about the question, what's the average time it took you to buy the property? What's the average time to sell the property? But if you look at the response rate to these surveys, they have super low response rates in the range of 10% of people who get asked that question give any answer. Maybe they don't remember how long it took them. So that's part of the question, part of the problem of getting these people to answer. Then we have online data. I myself have worked with Trulia data, where people define profiles of where they're searching, and you see how long they stay on these platforms. That gives you a notion of the relative number of searchers in different owner segments. For example, of the Bay Area. We did this for the Bay Area. But it's really hard to scale this up to the entire US partially because of in some portion of the country, the search for a house is not primarily over the internet. Another problem is that people use different platforms, even they're regionally different. So for example, in the Bay Area, Zillow works great for looking for rent. If you try to use Zillow for renting in another area in the US, it doesn't work. And so it's really hard to scale this up. And so what we're going to do in this paper is we estimate the model, and then we infer this difference between the number of houses and the number of people from the estimated model for each US city. And so that's where I'm going. And so I need a model. And so we're going to have many small open cities. The model is in continuous time. There's no aggregate risk. It's a very simple model. It has infinitely lived agents. They have quasi-linear utility in housing in numeraire. They discount the future with some rate R at which also their wealth accumulates. So it's a very simple model. They're born with exogenous income, and then they choose whether to go to the owner market or the renter market. So they have this 10-year choice. For those who want to go and buy a house, we put in a borrowing constraint, which is that the house price has to be smaller than some multiple of your income. That works like a down payment constraint. And then there's some exogenous rate at which you move. So the moving decision is there's a moving shock that makes you want to move. And that arrives at a rate sigma. And then once you move, you're replaced with an identical copy. So we'll make you move and then replace you in the city with an identical copy. Houses are indivisible. They give you some flow utility A, and this flow utility grows with income. So there are some amenities associated. They're all growing with income in the city. And then that flow utility is lower if you rent. So this is some warm glow for owning. So you're happier when you own the same house than if you rent it. So there's some multiple rho that lowers your utility when you rent. And you can buy or rent these houses in a search market from developers. Then once you're hit by this moving shock, you're going to sell the house or stop renting, and that's going to go to developers. These developers then receive the house, and then they will list the house, and the house will become vacant. So you see these developers. Initially, we thought we need them because they make the model tractable. The next version of the model that you'll see is going to have both developers and a selling back to the search market. In a search market, that's actually not more difficult. So we're going to have new houses by developers, but then trading among households. So this is a really early version that you're seeing here. These developer firms have quadratic construction costs, and they sell or rent out to households that they find in these search markets. So we have search markets for owner-occupied housing and for renting. There are potential buyers and renters that are going to meet these vacant houses that are sitting around that the developer has put on the market. Then we have random matching. So there's a Cobb-Douglas matching function and Nash bargaining over the price. And we'll assume 50-50 split between the developer and the household who is either buying or renting. We have these competitive wholesale housing markets where once movers sell or stop renting, so if you sell, you pay a proportional transaction cost, and then the developer buys either houses or constructs new houses, and then sells or rents out in these search markets. So the current version of the model has these search frictions for finding a house, but it doesn't have search frictions in selling. So you can always immediately sell to the developer. You see that that's an aspect that you don't want. So this is going to be different the next time you see this. And then we're solving a balance for balanced growth equilibrium in each city, where construction costs and the number of houses will grow with population, and the prices and rents will grow with income. That's what we're solving for. So let me give you some intuition about how this search market works by just looking at one market. So again, each city is going to have these two markets, the rental market and the owner-occupied market. But let's first focus on just one market. And let's get some intuition. Let's fix the supply of housing here and the population. And let's see what happens. So again, there are these two equations that say the number H of houses meets the number 1 of people, and there's vacancies and occupied houses and searchers and those who already live in the house. And that gives us this difference between H and the number 1, which is the population. If these structural vacancies are negative, we have excess demand for housing in the city. The problem is that these structural vacancies are not observable. We see the inventory, but we don't see who's searching. And so we're going to use the model to infer H minus 1. And so what's the key equation in the model? In steady state, houses are going to flow into the market and out of the market. And the inflow and in steady state, those two things have to be equal. So the inflow has to be equal to the outflow. And so how do houses come on the market? Well, somebody got a shock, a moving shock. And so H minus I are the houses that are currently occupied, and sigma is this moving shock. And so these are the houses, the number of houses that comes onto the market. They're being sold, and then or come as listings in the rental market. And that has to be equal to the houses that go off the market, so the outflow. And what's the outflow is the number of houses that get matched with a searcher. So you have number of searchers, a number of inventory, and then there's this Cobb-Douglas matching function that matches these two. So that's the key equation in the model. And I'm going to use this equation right here, solve it for the number of searchers, plug this in here, and divide by how many houses there are in this market. And that will give me a relationship between the vacancy rate, which is I, and relative to the housing stock, and the turnover rate, which is the number of matches relative to the housing stock. And so this is how this looks like. The left-hand side, again, is this outflow now divided by the number of houses. And so how does this look like in a graph where on the horizontal axis you have the vacancy rate, and on the vertical axis you have the number of matches relative to the housing stock. So that's the turnover rate. How do the left and the right-hand side look like? The left-hand side, you see, is just a linear function in the vacancy rate. I over H. That's just linear. And so here you're looking at this linear function. And so that's the inflow. And what's the outflow? Well, then that's this matching this Douglas matching function. And you see that there's I over H in both entries of this function. If you set the vacancy rate 1 over H equal to this term here, H minus 1 over H, then you have 0 searchers. And at 0 searchers, you get 0 matches. And so you know that the function starts here at 0 at this point, and then is increasing because matching rates increase. The more vacancies you have in this market, the more there will be matches, and that determines this positive slope of this M function. So that's the equilibrium of the steady state equilibrium of this market. So now I can think about how these curves shift when I have things change across markets. I have a cross-section of many markets. I got to explain lots of different equilibria. How can I do this? I can first of all have a market that has more mobility, a higher sigma. What that does is you can already see if you're looking at the mobility only matters for the inflow in the market. So what happens if people move more houses come onto the market. And so for any given vacancy rate, you have more turnover. So that just shifts this or tilts actually this linear function up. That's what happens. And so what you get in equilibrium is a higher vacancy rate and a higher turnover rate. So both move together. So you have more vacancies and more turnover when you have more people moving. So just a more mobile city. What happens if you reduce the number of houses? Well, now you have relatively more demand for these houses. In this rental market for these rental houses. So what happens? So now it's the right-hand side that shifts. What happens is that you get more demand. So there's now, for any, in equilibrium, we'll see a lower vacancy rate because we just took out some houses. And we have higher turnover because lots more people now turn around in this smaller market with fewer houses. So what we observe is the vacancy rate. And so now there could be two equilibria. One is the solid equilibrium and the other is the dotted equilibrium. One has low turnover, the other has high turnover. And so what's the slope from the origin to this point, to this equilibrium point? It's just the ratio of turnover to the vacancies. That's just 1 over the time on market. So if you're looking at the slope of this curve through the origin to the equilibrium, what you see is time on market. And if this slope is flat, you have long time on market because the slope is 1 over time on market. So then if the slope is low, you have high time on market. And so what that identifies is the structural vacancies in your model, because you see that this here, where these meet is this H minus 1 over H. And so that helps you identify structural vacancies. And so households, how do they choose whether to own or to rent? They have some mobility, so they can differ in the sigma. So some are very mobile, the others are not so mobile. And because ownership involves the transaction costs, if you tend to be a high mobile person, for example, a young person who's not settled down yet, then you're high mobility. And what you do is typically rent. So this is an argument against buying these transaction costs. And the other is this down payment constraint, or this, more generally speaking, borrowing constraint. So the income matters. You must be rich enough to afford to buy. So there are these two reasons. What happens on the firm side, that these developers, they have to think whether to put any given house on the ownership market or on the rental market so that they're found by somebody who wants to buy or rent. On this wholesale market, there's a price P, And then these firms have to be indifferent. So what this indifference condition looks like is like this. It's 1 over the time on market of that particular market times the surplus of the firm from the trade, from this match. And the surplus is here the expected sale price minus this wholesale price P. Or on the rental market, it's 1 over you're looking at the 1 over the time on market for renting, and the surplus is the expected present value of the rents minus how much this house is worth on the wholesale market. Since time on market will decrease with the Q, so the number of searchers relative to the number of vacancies. So the more searchers you have, the lower the time on market. What happens in equilibrium is that the number of vacancies adjusts to make developers indifferent between listing for sale or listing for rent. And so this is the key mechanism in the model, is that the rental market has very low surplus for these developers. Why? Because first of all, you get lower flow utility as a renter, and so therefore you are not willing to pay very high rent. The other thing is that typically in equilibrium, there's going to be sorting, and the high mobile people will sort into the rental market. Both things together means that you have, this is low here, your surplus, firm surplus is low. And so what happens is that time on market adjusts. It gets shorter on the rental market so that these developers are indifferent. And so again, the idea is basically you're a developer, you think about whether to list this for sale or list this for rent. You see that there's very low surplus from you for listing it for rent. And so what has to happen is that time on market in the rental market has to be very short so that you have an incentive to put it on the rental market. Because on the ownership market, you have a very high surplus. You have these households who are very mobile. They're willing to pay a high price because they get a big flow utility from the house. And so what happens is that in equilibrium, the time on market in that market is going to be much higher. So that's the key. OK, so how do we put numbers here? We're using mostly census data. Most of the cross-sectional data comes from the year 2019. So this is data at the MSA level. So from there, we get the housing stock, things like tenure choice, whether you own or rent the house, the vacancies for rent. There's a variable in the census, vacancies for rent and vacancies for own. There's a median rent in the census, a median price, house price. And then we measure the turnover rate by looking at the fraction of the population who recently moved within the last year. There's a question like that in the census that asks you, did you move in the last year? Then we also have the distribution of income and population growth. For population growth, we need a longer sample. But most of the cross-sectional data is from 2019, so pre-pandemic. And then we get inventory for sale from Zillow. So here we have all the listed houses from Zillow. We're going to parameterize this in the following way. We have 2 household types. We make one of them is going to be high mobility, the other low mobility. And in equilibrium, we pick these numbers so that they're sorting. So you have the rich and low mobility households, they choose to buy, and then you have the poor, higher mobility households who are renting. I'm a little worried that you're not asking any questions. So I hope it's clear. Oh, OK.
That's a question, actually.
Yes.
What are you doing about short-term rentals? Are we just abstracting from those right now, since they're not going to be housing, technically, they're going to be like commercialized?
So short-term rental, as long as they show up on the market again, they will be my vacancies for rent measure. And so that should pick it up. So let me do some preliminary step. Let me first show you something that I've already shown you at the very beginning. I'm going to show you a strong common variation in time on market in these 2 markets across US cities. So cities that have a lot of high time on market in rentals also have them in the ownership market. And so one way to think about this is that if you project own and rent time on market on the first principal component of this data, it explains 75% of the variation. So it's huge common variation. And you saw this earlier here. So here is the month, again, the month supply with, I don't want to add text, the month supply for New York City, you see it right here, and many other cities. And typically in the west of the US, we have shorter time month supply, and then in other places like the south of the US, you have longer. And then in terms of how people sort, what matters for sorting is the income distribution, whether you're rich or poor, and this flow value that you're getting from housing, because you get less when you're renting. And so that matters to the boring constraint. And so to get some sense of the sorting, let's compute the share of households who are really rich in the city, because we have the distribution of income for each city. So we can look at who's rich in the city compared to, let's say, the median house price in that city. And so the number we take is 10 times income. So let's look at the share of households who have whose income satisfies this inequality. So 10 times their income is higher than the median house price. So that share is extremely high correlated with the ownership rate in the city. So if you have a city with lots of very rich people, the ownership rate in that city will be high. So that's nice because we want rich people to sort in the ownership market. What I'm also going to show you now is it's strongly positively correlated with rental turnover. And so let me first show you the graph and then give you my intuition about it. Here's the graph. So here's the share of rich households that make, see here in New York, you don't have many rich households because house prices are so high that it's hard to find the household who has 10 times, 10 times income is higher than the median house price. So here is the rich household share. You see why we picked 10, so now there's some variation. If you pick that number too low, you have too many rich people. So in order to get some variation, we look at 10 times income. And on the horizontal axis, we have the turnover in the rental market. And so what I like about this is that basically in places that have low turnover in the rental market, that means that lots of people who are quite immobile, they stay in their rental for a long time, are in the rental. So these people sorted themselves in the rental market. And so then the question is, why? How can that happen, that you have cities where not many people are moving in the rental market? That's because they have to sort there. In other cities, those people would be owners, but they don't have the income because the share of rich people in that city is low. And so vice versa, in markets where you have a lot of turnover in the rental market, it looks like a lot of very mobile households are renting in that market. Why? It's because the sorting worked out, because in that market, in that region, you have lots of rich households. Those rich households bought, and so they are immobile, but they now go into the ownership market so that you have a rental market with a lot of turnover. That's the intuition. And so we were excited when we saw this because we thought, we wrote down this model where people sort. I have no idea whether that's actually going on in the data. And we were happy to see that there's some evidence that actually, yes, you have sorting in the way the model is telling you. And then we set some parameters, like we put a lower flow utility from renting. We pick an interest rate. We set transaction cost to 6%, and we pick the number in the, so this is your Cobb-Douglas matching function with equal, with 50% on each inventory and searchers times M bar, and M bar is a constant that we pick to just, so that the time on market is equal to the time to find a house in either the rental or ownership market. Okay. And this is on average across all cities. So in the US, so this should remind you of what I said at the beginning. How do you usually pick the number of houses? What we do here is for the US, we say, because we don't have a way of identifying it, for the US as a whole, there's the number of people equals the number of houses. But for each individual submarket, that's not true. And so that's how we pick this M bar number. And then there's moments that we're matching. And this table here is sort of the usual lie of making it look like this number matches exactly that moment. But that's not true, because this is a nonlinear thing that where these 5 moments match these 5. But mostly mobility matters for turnover. And so the mobility rates for these high mobility types and low mobility types matches the turnover in the rental and ownership market. The share of high mobility types in the population, that matches quite closely, that determines the ownership rate, together with the number of rich people here. And the marginal construction costs matters a lot for time on market in the ownership market. So basically what we're estimating is a really high, these are all cross-city medians. So this is the median marginal construction cost, which is fairly high. So you see about 4 million in construction cost of putting on the market a new house. And that's high, and that determines the time on market. So the model says if you don't see enough houses, it's because it was so expensive for the developer to build a new house. And so it's estimating that to be high in the cross-sectional city mean. And then we estimate this growth rate of income across US cities was very close in real terms to 0. And then that pretty much determines the ratio of rent over price. That's because basically how houses are priced here is you can think of a Gordon growth model, because there's also some search discounts in the model, but those are small. So you're deviating. So it's basically the Gordon growth formula adjusted by a term that adjusts for transaction costs. So you use the time on market to adjust for transaction costs. Yes?
Just because you wanted a question. So the previous slide, so most relevant means some kind of poor man's Hessian or something like that?
Yes.
That's what.
Yes. Yes.
What should I have in mind is varying across cities? Like these are all
Yes.
things that seem common to all
Yes.
of the cities.
This is, yes. So they're common, well, but I'm showing you the median. So we're matching the moments for each city. So these numbers vary depending on the city, and the cross-sectional mean are these numbers. So we actually have a lot of things that vary, but think of, what's really important is the sigma. That's a key difference, is how mobile are people in New York, and there's a lot of mobility in New York, and that determines. Then there are other moments, like the growth rate of income vastly varies whether you're looking at Detroit or Silicon Valley. There's huge differences in that, but in this estimation with MSA level data, it looked pretty flat as a median with huge dispersion. So all these things vary.
You take the sigma, the shock is given.
Yes.
And you have the wealth is given.
Yes.
In fact, in reality, you have everything joined.
Yes.
Determined.
Yes.
People with different sigma self-select
Yes.
different cities according to the rental situation in these cities. People with different wealth self-select to different cities.
Yes.
You take this as given and you take it from there.
Yes.
But I would say that in order to solve the model, you have to determine everything.
You're asking a terrific question. You're 3 steps ahead. So I'm just behind you, because I take these things as given, like income. I take it as given from the data, what you're making in New York. And then I take as given your some probability, and then I'm matching moments of the housing market to pick the mobility number. The income just comes straight from the census. what you want me to do is that people sort in these markets, which is a fascinating question, and actually Stan has written a paper on this, which is a great paper, on people sorting across different markets in the US, and then you can think about, how does income in different places show up in house prices. I'm not there.
The rental versus ownership.
Yes.
With everything else is different.
Yes. So for me, these things are exogenous. Nothing in life is exogenous. Everything is endogenous. And I just need to work harder, and then next time I may have this. Only the weather is exogenous, I guess. And even that, even there we're having some debates, even there. So here is a picture of structural vacancies and time on market on the ownership market. And so here you see how time on market really matters for identifying my structural vacancies. So you see that regions in which time on markets is low have low structural vacancies, negative structural vacancies, and regions where this is high have a lot of structural vacancies. And so what you're looking, so here I highlight 0. And so you see that in the ownership market, you have quite a few places that have too much housing. New York, interestingly, is among these cities that in the ownership market, there's this graph, our estimation says you have a lot of houses in New York, but there's many markets, especially in the West, these are basically all Californian cities, is you have a shortage of housing, even in the owner market. And then so here's structural vacancies in the rental market versus structural vacancies in the ownership market. And so here you see where the zeros are. So this is 0. This is just as many people want to rent as you have houses, and the same thing here. And now you see the very positive, strongly positive co-movement in these two series, structural vacancies for rent and own. You see where New York is. So basically what our estimation would say is that there's a deficit, there's excess demand in the rental market, but not in the ownership market. So that's a result of this estimation. While it says in Western cities, there's a lot of excess demand in both markets. And then there's other markets, mostly in the South, but also in places like Detroit, that have too much housing relative to the number of people. And here you have the same picture with some names on it. And so there is New York. And so you see lots of Western cities here that have excess demand. And so if you want to think about, in terms of policies, what should we encourage? It seems like the US is a market where, in terms of ownership, there's many markets or regions where in the ownership market you have enough. There's enough housing, you don't have to build there. But in terms of the rental market has a much more need for more housing. That's the idea. Okay, so what I've shown you today is a search model, a very simple search model that has a tenure choice. So there's a rental market, you can choose to rent or to buy. And it has financial frictions because of this borrowing constraint. We estimated this model with data on the cross-section of US cities. What's key for determining structural vacancies in both markets is the time on market in that particular market. And then what the model does, it's accounting for this co-movement across markets in vacancies and time on market. The key mechanism in the model is that whoever decides whether to put the house to list it for sale or to rent has to be indifferent between these two. Because the surplus is so low in the rental market, what has to happen is that the time on market in rentals has to be very short. Otherwise, you're never listing it for sale because you have these people who don't want to pay a lot of rent because they have this low flow utility. They move a lot, so it's going to be empty again soon. And so all of that generates a low surplus, and so that's why time on market in rentals has to be short. There's negative structural vacancies in the majority of cities. It's driven by this high construction cost, and it's especially high in the West. We estimate this construction cost to be especially high there. It's more negative in rental markets, so they are what's sort of the excess demand would be, too many people relative to the number of houses, even if you take out any such frictions. It's positive. There are many cities where you have enough housing in the owner market, but not enough rentals. And there are few vacancies, which means short time on market, and that, I've said this already, here the cross-sectional differences basically reflect how people sort. So how you change the renter pool as these parameters change. If you have more mobile renters, there's going to be more structural vacancies in the rental market. Because there's a lot of turnover, people move all the time, you're generating a lot of turnover, that generates more structural vacancies. Or if you have more constrained people, then you have fewer structural vacancies in the rental market, because they all have, there's now excess demand. These poor people all now have to look for a rental place, and that's what's generating these differences. Thank you very much. It's strengths now. You have to close it.
I think actually we were taken very seriously when we said no questions. I mean, like, generally this audience is less compliant. So we have actually a few minutes now. If you guys would stand, you have a question?
Yes.
So I was just wondering about like the main mechanism of this margin of substitution between owning and renting.
Yes.
Right? So sometimes, you hear developers talk about this. I mean, my views are very skewed by New York City, which is a very particular housing market. But sometimes they will say things like the only asset that's profitable to build is a condo asset, not a rental apartment. Presumably they could have chosen to build an apartment, and it's usually it's correlated with the land price. So I was wondering whether your model has kind of anything to say about that choice. It seems like I haven't heard them argue, the turnover is too low or something like that in the rental market.
Yeah, so we're going to say they're behaving as if they're worried all the time about turnover, but you're right, the construction cost will show up in this wholesale price that is going to be determined in equilibrium, and so there's going to be places where even constructing new houses is going to be less beneficial for developers because it's so expensive. And the other thing is that what you may have also in mind is differences in, so right now we're imposing the same construction costs on both houses. Maybe those may be different, and that's an interesting idea to explore, I think, to go down that road and to say maybe rentals have a different construction cost from ownership markets. We would have to think about which additional moments to match to get those parameters, but it's an interesting idea. So here the key, as I said, is they're comparing their surplus with time on market, and because the surplus is so low. But I feel like when they think condos are better, maybe they have surplus in mind. Maybe not time on market, but surplus.
Exactly. Maybe the profit margins are different.
Yes.
It seems like there's a very natural measure of housing market tightness here, which would be searches for vacancies. And I'm just wondering, is it useful to tell the story in these terms? For example, time on market must be inversely related to housing market tightness. That's like a job finding probability. I'd imagine that rental, so the amount of renting is related to housing market tightness as well.
Yes. So time on market in the rental market is related to tightness, absolutely. It's the way we compute the model is to determine tightness, and then that gives us all the other variables. So you're exactly right. And I could have, I showed the next version of these slides. have that story. Yes.
I'm wondering if there's also some structural differences related to the time to get an apartment, whether you rent or you buy, that are related to the fact that when you buy, you're kind of like looking for more specifics, right?
Yes.
It's like more durable. It's a larger durability. You want to kind of like match it more better with your specific taste than when you're renting. Whether that may also play a role in the data or not.
That could. So you want to see more heterogeneity in the housing side, essentially. There may be, if I'm super rich, I can wait until I see the house that perfectly matches me. Yeah, that's not here. Yes. Yeah, that may contribute. That's a great point, actually. Yeah.
I'm just wondering about technological change in these markets. So it seems like one of the new developments we've seen post-financial crisis or sometime, or iPhone development or something.
Yes.
The ability to buy up entire neighborhoods
Yes.
with a single family.
Yes.
Rent them out. And,
Yes.
And do you see that as
Yes.
potentially changing these markets?
Yes. So you're moving exactly in the direction that we've been moving with our setup. So here right now, these developers sell all the houses and they buy from households and it all goes to developers, but different markets, as you say, differ in how many institutional types you have. And so that's very easy for us to extend the model to have household to household selling and buying versus going through institutional investors or BlackRock or whoever that may be. And we have data, so we can exactly tell which share of the transactions goes through these institutions as opposed to. So this is exactly where we're going. Yeah.
All right. So I'm sorry, so because now in fact it's time for. So of course we would love to stay here for forever, but we have a reception to go on. So I'd like to take a chance to thank Kenney.
Thank you. Thank you.